Today, folks, we're going to dive into what is happening with the Canadian real estate market and what does this mean for your favorite Canadian REITs to buy everything from the RioCan to Canadian apartment properties down to those industrial REITs, obviously like Granite Real Estate. As we also broad view the ETFs that are largely suppressed still, what this means heading into an interest rate cut cycle and everything you need to know in between. So consider hitting that like button. As first and foremost, I told you guys the opportunity to buy physical real estate is starting to go by you. As mentioned, we purchased real estate in what was supposed to be the worst possible time to buy because it's very expensive to get a mortgage, but we put a higher deposit down, and now the market is starting to normalize as people start to get used to these higher interest rates, and the market conditions are heading back up, and it's going to be even more insane when they start cutting interest rates and more people can get approved for mortgages. The Bank of Canada worries that rate cuts now could overheat the spring housing market, and we all know they'll probably push major interest rate cuts off till the fall, into the winter, and then probably more into 2025. But we're going to head more toward a market that is probably similar to New York, because at the end of the day, there's just not enough supply to meet the demand. And if we take a look at the residential stats, even in this higher interest rate market, we can see that total residential transactions are starting to nominalize. They're back up 18% year over year. They're actually down seasonally on a month over month, but that can be expected. But I'm sure as we head into March and when buying pressure really comes back, that the transaction volume will jump month over month. But the average selling price is now at 1.1 million, up 1.1% over last year and 1.3% just over last month. This all during a period when there's a 33% spike in total listings. But many of us knew as basically the interest rates went up, there was a lot less volume on the market. So we're just heading back to a more nominal environment, right? As again, people adjust to all this, but it takes a while. People are spending a little bit more time looking at properties. There's still probably a little bit more bidding going on. I mean, probably not like the bidding wars that we saw, but people just don't probably seem to be in as much of a rush to buy. As the average days on the market is still up 12% and 13% on a month over month basis. So that's kind of the general market. As we zoom into kind of the more commercial stats, more related to your RioCans, your industrial REITs, and basically we can see that all leasing activity is actually down. And I'm sure you've been to your malls, seen a lot of malls circling a lot of different brands that are coming and going, seeing a lot of turnover. On the industrial side of things are relatively flat from a leasing perspective. Commercial REITs here, we can see the actual insanity that year over year the rates have gone up quite a little bit by 23%, and the average office is up 4.5%. So for the death of office, the death of retail doesn't really look that way. Even with the turnover in tenants, it seems office and retail are actually doing pretty good right now. Condominium sales also very interesting, down 3% year over year. The average selling price has been about flat, not a whole lot changed there. Total new listings up 29%. So again, seeing a lot of people in every aspect of the real estate market putting their properties up for sale. Looking at the condominium rental prices, which I find most intriguing, the average one bedroom is up 2.2%. and the total apartment rentals are up 12.6%. But what I really want to focus on is this average rental price, because there's been a lot of news recently that the Toronto rental prices have actually been declining, which I find absolutely fascinating. Because if we take a look, for the first time, people are probably tired of spending an insane amount of money on rent. And I just want to focus on Toronto specifically because for the last 2 months, apparently we're seeing a declining price of about half a percentage point. So the average one bedroom is now renting for about $2,495. Two bedroom is down about 1.3% month over month to about $3,287, as we see people just not wanting to spend $40,000 a year on rent and are probably trying to find other ways to live, whether it's with parents, friends. I mean, people just, it's an insane price to ask. And this has only happened within the last few years that we've seen these prices for rental really explode, which bodes well for a lot of the REITs that we are going to look at, because again, even going down 1% or 2% in rental prices is nothing compared to where it used to be when you could have got a 2-bed, 2-bath somewhere probably for around $2,500 to $2,800. But taking a look at the REITs that get most affected by rental prices, Canadian apartment properties, probably one of the most stabilized REITs in Canada, currently yielding almost 3% on its dividend. I still think a very great buying opportunity, as the price is up slightly year to date, but on a 5-year basis, we are still very suppressed. And these REITs will probably trade in this area at least until interest rate cuts come. But because their average rental price across their entire portfolio is just over $1,500 to $1,550 a month, as tenants turn over, they're going to be able to capitalize on the higher interest rate market or the higher, rental market. Because again, we're kind of, rental controlled here, especially with their properties in Ontario. They can only raise the rent on current tenants so much each year. So the only way to actually capitalize on the higher rental market is to get those tenants out, but you can't just kick them out, right? So this company will continue to bode well and continue to see an uptrend no matter what happens as tenants turn over. Now, if you take a look, very intriguing here. We can see their operating revenue is up 5.9%. Net operating income, they've really done done well in the last quarter, up 7.4%, which is great to see. Their current payout ratio is 60%. This is a great REIT overall. Dividends don't increase very much. Don't expect huge dividend increases here. They haven't increased since basically 2021. But again, just for stabilized income and a likely recovery that's going to happen on the interest rate cut cycle, you might not do too bad if you're an income-oriented investor. Same with on the Granite real estate side when it comes to the industrial, which had some of the best returns out of the whole market and is still in a very suppressed environment with a 4.3% dividend yield, globally diversified even outside of Canada. Very intriguing if you like the industrial side of things. Revenue also up for the year end, 521 million, and even on the quarter-over-quarter, up nothing huge, but still up nicely against the backdrop of higher interest rates. We can actually see here, if we take a look at the payout ratio, is also 63%. Again, these are some of the most fabulous REITs you can buy. We've been seeing some earnings come out of our favorite retail REITs like RioCan, which are continuing to be largely suppressed in line with smart centers. These are where you're going to get your maximum, like crazy huge yields of 6%, and they are starting to increase the dividend again, which is really nice to see, getting a crazy mix with the top tenants being things like Canadian Tire, TJ, X companies, Loblaws, Cineplex, Metro, and Walmart. This company is doing very good as well. I mean, the rental revenue continues to do bodingly well. As we take a look here for the year to date, they did pretty much up slightly for rental revenue from 1.06 billion to 1.074 billion. Nothing too crazy there. And again, if you take a look at the payout ratio, the adjusted funds, you're taking a look at you're sitting closer to 67% on the year. So they're all falling kind of really closely in line, where Smart Centers is getting hammered a little harder than RioCan, paying out almost an 8% dividend yield, taking on a little bit more risk with roughly the same tenants. If we just take a look here, we can see that, just scroll down, the rental basically income largely has been unchanged in line. I mean, a little bit similar to RioCan, going from 804 million to 834 million. But what's most intriguing here is, again, you take a look at the payout. It's a little bit higher, right? The payout ratio is sitting at about 90. I mean, adjusted, it's about 98%. Like, they're paying out most of their income, right? So you got to be a little concerned on the 3-month ending, taking a look about 89%. It's always in the low 90s. Just got to be a little careful with that because if anything really bad happens to a company like this, you're going to run into issues. But again, that's how you maximize yield, right? And this company has a lot of development going on. They're probably one of the most, in line for the most insane development. I mean, you look at all these properties across the board. They're building cities around malls because these are the companies that are the only places that have real land, right? Like RioCan, Smart Centers, they probably have the most land in one of the most condensed cities anywhere, and that's why they're going to take advantage of building massive, basically small cities around their malls and their property, because they're the only places in Toronto that actually have the capability and the commercialization to do so with permitting. Look at the insane amount of properties. I mean, it's crazy, the development here, right? So all this kind of boils down to, I would only really be paying attention to these if you're really looking for income, right? Like, I think they're going to be great recovery plays. If you're more toward a retirement stage, you want diversity, that's what I would be buying these for. In our portfolio, we have a bit of exposure to RioCan, but it's nothing that I would be going, crazy with, because we can see that if we take a look at the Vanguard FTSE Canadian Capped REIT Index, it is down 21% still. It is up pretty nicely off the lows, up about 20%, but I wouldn't be buying this because the yield sucks. You're getting around, I think, 2.7% across it because it really focuses on financial services that really don't yield as much, because that's been the better performing sector in the Canadian real estate market. Transacting real estate continues to do well with like First Service Corp. But I still think owning the individual REITs come with enough diversity in and of themselves. They're already like owning a diversified portfolio. Personally, I would be focused more on the US side. Even with my parents in retirement, most Canadians have most of their money sitting within their property. So I don't think it makes a lot of sense to also be buying Canadian REITs. You might want to diversify more into the US, where we're also seeing suppressed real estate prices and things like the Vanguard Real Estate Index Fund, ticker VNQ here. This is where I'd be more intrigued by because the yield is much higher at around 4%. But if you scroll down and you take a look at the holdings, much more diverse. I think much more focused on things from like data centers and American Tower, companies that are really, really diverse. I mean, American Tower is more focused toward telecom giants, giving you diversity and just pure telecom real estate. And again, like just really interesting things like Realty Income, another awesome REIT, Public Storage, really awesome REIT. So again, I'm always a little bit more biased toward the US side for performance, but there's nothing wrong with picking up a few individual Canadian REITs. But this is not financial advice. This is just one man's opinion. But I'll pass the question off to you. Where do you think the Canadian real estate market's headed, and are you buying these REITs?